Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Elisa, thanks to you for taking some time to join me on the show.
No, thanks, Owen. Great to be here.
Last time you spoke with Kate. We've spoken a couple of times before, and I've seen you present and do some things, and it's always refreshing to hear you talk about investing and see how passionate you are. For folks that haven't seen the recording with Kate, I will put a link in the show notes for that. I've got a few icebreakers that I've been asking, particularly here on my trip in Sydney, and these are a bit more personal, and they come courtesy of the team. They think it's kind of like, show me what's in your portfolio kind of thing, or show me what you're actually doing. And the first one is, what was the most recent company or thing, it can be anything, that you've invested in?
Yeah. So I bought a house last year, which was really exciting. But given Sydney house prices and rates, my big investment is into the offset account lately. So
that's fair enough. And it's totally fair because, like you said, interest rates.
Yep.
Also, it's a very big purchase here in Sydney.
Yeah,
fortunate to be in Melbourne, where it's not as big, but still pretty daunting.
Yeah.
But thirdly, it's always good to know that because it reminds us that investing is this whole of wealth picture.
Absolutely. Yeah. Absolutely.
So if that was the most recent, what was the first?
Yeah. So I invested in BHP when I was a teenager. I knew very little about investing at the time, but it was really just kind of get your feet wet. It was only a small investment, but it just taught me a few things. One, just about the news and financial reports and starting to look at that, but then also that resilience in the market where the ups and downs that you're experiencing. It was important to just start ripping that Band-Aid off from a young age, I think.
Yeah, absolutely. And you started at the top being BHP, which is the biggest company in Australia, at least on the ASX. And it's one of those things I find when you start, well, what are the names that you know? BHP,
Absolutely.
Telstra, Woolies,
Absolutely.
these types of things. It's definitely, I chose NAB, and had I had the choice, I probably should have chose BHP.
Yeah.
So I think you've got some brownie points over me on that one. The third question as an icebreaker is, what investing tool, resource, could be a website, could be the team internally, could be anything, do you find that you're using each and every day in your job?
Yeah, so we at Magellan, we're global investing. So the global tools that I find really useful are the FT, and then there's a blog called Axios, which is really useful. It's a news and opinion based, but it's just short form, usually kind of a few minutes read per article, and they've got different themed newsletters on AI or on markets and politics. So it's just like a nice little snapshot that you can easily digest on the train.
Oh, I like this. Okay, I'm going to try and track that down and pop it in the show notes for folks. So the body of today's conversation, you could even say the core of the day's conversation is around moats and companies with wide moats. I thought this theme would be really attractive, not just because of the way you invest, but also because people that are listening to the show or watch it, they're really interested in finding really high quality businesses that they think they can hold for a very long time and probably they're familiar with. And indeed, 3 of these companies that you're going to bring to the table in a moment are 3 companies that I'd assume everyone is familiar with in some way. But the fourth one is one that I said to you off air, I don't know anything about this. So this is going to be heaps of fun. But before we get to that and the companies, a few questions about moats. What is a moat and why is it important?
Yeah. That is a great question, and I'm glad we're starting there because it's a term that's used a lot in investing, and it's complex. So I think let's just start with the word moat. I think is quite important. So most of us know the word moat, perhaps from fairy tales or medieval times, where it's protecting the castle, and there are different things that can protect that. The castle in the moat, it could be wide, it could be deep, it could be with water, it could be the crocodiles, right? So just keep that in mind. Then now we're talking from that investing lens on what is a moat or an economic moat.
Yep.
So in the investing sense, what's most important is future earnings. So when a company has an economic moat. It's how can it defend its existing earnings so it can earn them in the future, and how it can grow earnings. So it's that protection part. So that's that kind of similarity and why the word really exists, and how we've translated it into the investing world. And as we mentioned on the medieval sense of a moat, that there are different ways you can protect your castle, or in this case, company earnings. There are different elements that we look for that can protect the earnings of a company. So we call them economic forces, and that could be its industry structure, or it has scale advantages. There are different features that we're looking for when we're trying to identify whether or not a company has an economic moat. One of the simplest kind of companies to talk to that everyone I think can relate to is your utility companies, specifically that transmission distribution part of the business. And in the US, these are typically your monopoly companies. They have regulated returns. But what product are they focused on? They're connecting the grid to your home for electricity. Now, that is pretty much a guaranteed demand for that product. So that's where you've got a moat there, because we've got a lot of certainty in the earnings of that business into the future, because I'm going to guess, Owen, if you had a choice.
Electricity.
Yes, you've got it. And will you turn it off?
No,
exactly. So that kind of gives us that confidence in the future earnings of that business. And that's really the kind of what we're thinking about. We're thinking about an economic moat.
Yeah, it's fascinating. I fielded a question. We had one of our community members write into us the other day, and saw the I think it was voluntary administration in the end of Booktopia, which is the Australian business that sells books online. People will be familiar with, and that had an IPO a couple of years ago. And they said in their question, were there any signs that this was going to happen? And some people just quickly jumped in the community and said, well, if you look at the financials, blah, 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 blah. But they said, well, I'm not a finance person. I don't understand that. Can you break it down any other way? And then the other people jumped on and said, well, there's a thing called Amazon, and Amazon is a beast, and Booktopia was an Australian business, very different customer experience. And I love that idea of if you're listening to this and you think, I don't understand the financial stuff, but I do admire different businesses, I think a moat is a really interesting way to kind of illustrate that. So in terms of actually measuring it, in terms of actually understanding how you look at things, because obviously you do have the skill set, how do you think about measuring a moat? Maybe it's wide, maybe it's deep, I don't know.
Yeah.
How do you think about it?
Yeah, no, it's a really good point. And I think the scene setting you did then was just perfect, because there are different ways to determine whether or not a business is quality. The historical data is important. We can't ignore that. So that's looking for whether or not the business has an attractive ROE, that it's been sustained over time, does it have sustainable revenue growth. All of that's important, but that's just what's happened in the past. For us, really, it's can the business continue to do that into the future? Can it continue to protect its earnings? Can it continue to grow its earnings? And to do that, unfortunately, there's no kind of download button on Bloomberg or FactSet to do that. It's doing the research. It's understanding the business itself, its peers, understanding the industry to identify those economic forces that we're really interested in. And so I gave a few examples of what those economic forces were before. But on an industry structure, for example, we're looking for companies that are either a monopoly, duopoly, oligopoly, because when you've got that concentration, there's typically a little bit less competition. You're looking for companies that have a really strong brand. So that's where your consumer is trusting the product that you're delivering, that when you may not have the best fashion out there, but they know this is a quality product, all of that really comes into play. We look for company has a scale advantage, because that typically leads to stronger economics. We're looking if the company has pricing power, so can they increase prices and revenues can still continue to grow. So there's lots of different attributes that we're looking for in companies that give us conviction that they can continue to grow into the future. ASML, I think, is one great company that we view to be quality, view to have that wide moat that we invest behind. And its industry structure is something that is really attractive. But it gets that industry structure because of the strength in business and its barriers to entry, which is its IP. And it continues to invest behind that IP, which means that it has that almost monopoly industry participation, which is then leading to those attractive economics. And so it's having that thoughtful consideration of what is the business, how can it succeed, and then that constantly reviewing your thesis, because we know technology keeps changing, and just making sure that view continues to be forward-looking.
Yeah, and for those that don't know, the ASML business creating lithography
yes,
machines
that's right.
for the massive wave of computing and AI and all these things, just depending on this one company's technology.
Yeah,
it's fascinating. I often think, and you mentioned it there, you mentioned the idea of pricing power, and I think of like if we think of so we've got wide moat. I use that phrase deliberately because wide meaning that it is not just a company that has a moat, but it's like a company that has a wide moat. It's a strong version of that.
Yeah.
And I often think of those companies as having the ability to, as you said, to increase prices and either retain or expand their customer base, which is kind of contrary to most people's understanding of economics or how finance and things in business work, because you increase prices, you expect to get less customers.
Yep.
And fewer, again, spending more. But some things and some businesses can do that. Is that similar to the way you think about it?
Yeah, so pricing power is quite an interesting one, and it's something that we look for. But when we're talking about those economic forces and different ways you can kind of protect your castle or your company, it's not the be all and end all. We're looking for like that range of abilities to defend the business. Now, there are some companies that, because of the quality of the business strength in brand, that they can execute on price. So Hermes, great example. I think it's 7% a year that they can continually add on to their products, and the demand remains there. It's very much inelastic. But what a lot of companies need to be doing is, yes, they can get that pricing power, but the second point that's really important is that they need to demonstrate value as part of that. And there's several reasons why that's super, super important. One is it's protecting your customer. You're still maintaining goodwill. Your customer will have a favorable opinion of your brand because you keep giving something when you're taking more price. And then the other element is potential litigation. And so if you take too much, these businesses, we like that industry structure. So if you're a monopoly or a duopoly, you're often going to get the watchful eye from a regulator. And when you're giving value with a price increase, then the risk of being anti-competitive is lower. And so that is really important, that importance of innovation, to enable you to take the price, but then also to protect your moat. And ASML has just been a great example of that. So they're leading edge with respect to the manufacturing of that lithography equipment, which is needed for semis. But there are other competitors. There are others that are building these machines, and they need to continue to innovate so that they can be the leader, the best in class, that strength in brand that enables them to offer those products and continue to protect and grow earnings into the future, because competition is there. These businesses are earning really attractive returns. So people want a slice of that. So you've got to innovate still to make sure you're protecting the quality of your business. And some of the companies we're going to talk about today, that's a really important theme for these businesses. And that's why you have to keep reviewing your thesis on whether or not this business is quality. Because if they're not protecting the moat, then someone else wants a slice, really.
That goes back to that analogy of the moat. Like if the castle lets the moat run dry, it's kind of...
Yeah, absolutely.
The castle's just vulnerable, right?
Yeah,
so you've got to keep making sure that it's wide. You got to keep investing back into it if you're a business. I often think a lot about that. Like the one of the businesses which we're going to talk about is Microsoft. And some people may not remember, but in the early 2000s, it was one of those businesses that was so powerful that the regulators were starting to look at it and saying, hey, you need to stop this. You need to get Internet Explorer off that desktop and you need to get it out of there. It's too powerful. And many things went on and happened since then. But, it kept investing. It kept consumers so happy the whole way along. So I've lifted the lid on one of those companies so far, but there are 4 that we want to talk about, which is Visa and Mastercard, Stryker, and Microsoft.
Yep.
Which order do you want to take them in?
Let's start with Microsoft. If
Sure.
you've touched on that one, might as well.
Okay, ruin the
Keep going.
surprise. So people know it, right?
Yep.
Like that's a Microsoft device. I can literally see the Microsoft logo between me and you.
Yeah.
So people are familiar with the business. If you want to tell us a little bit about it, though, maybe why you like it, and also let's talk about that moat element as well.
Yeah, absolutely. So Microsoft is a technology company. Most of us are using it, be it their software, hardware, or unknowingly using it through their cloud business that they have that so many corporations are increasingly using to run their operations. So it's US business, but its revenues are very much diversified across the world. It's one of your Magnificent Seven companies that have been so interesting to watch the journey of this business as it continues to grow. And that growth is been really twofold. One is that innovation element and the quality, but it's also those structural tailwinds that it's linked with, and that is that productivity piece and the software piece, but also that cloud computing tailwind that will kind of keep this business going for decades to come.
It's fascinating because I can't remember the exact day when it was like founded, but let's say 80s.
Yeah.
To think that it's been at the top of the pack for so long, and yet it still seems so strong.
Absolutely.
And then people aren't always familiar with the different brands that are under the hood for things like LinkedIn, which is just, you don't really appreciate that unless you know, even things like Activision, Blizzard, like these businesses, you're just like, oh, really? And then that's just those. There's all these other things that come with it. So what would you say is its competitive advantage?
Yeah, so there's a few things on competitive advantage for Microsoft that are really interesting. I think the innovation and first mover advantage has to, in my opinion, just be at the top because of that, it now has the scale. It has that industry positioning. And that's really all just comes from that initial nugget on that just constantly wanting to be the best and creating a customer experience where you're just it's solving the needs that you have this product for. And what makes that really important is it's really tough for competitors then to come in and take a slice. So on the Office productivity suite, like they don't put numbers out there, but it's likely kind of up to that 90%. Like it's pretty incredible. Now you could just sit on your laurels at that point and just be like, we're the best, people keep using it. But they've never done they don't do that, right? So you just think of the last 5 years as a snapshot and your experience with Office. You've had Teams drop in, you've had OneNote drop in, and excitingly Copilot is the next wave of what's going to be added and integrated into the Office suite, plus all the different functionalities within the existing software. So what they're doing there is just making it really sticky. It's that really, like, customers are very sticky. Their desire to try something new is lower. So that means that they do have an element of pricing power, albeit it's coming with the innovation like we talked about earlier. And as an investor, that's super attractive because it's typically a subscription revenue, and subscription revenues give us a really kind of great comfort in that future earnings that this business is going to have. So we really like what Microsoft is offering on the quality side, and then the tailwinds and the opportunities coming through from cloud, from AI, and just that the software piece that's got through Office. It's such
a fascinating business. So I got for full disclosure, I am a Google Docs user, and I have been probably because I was too tight when the business started up to go and pay for the subscription. But I'm obviously the anomaly in this regard. And what I've noticed over the years is those subscriptions started really low, like the Microsoft subscriptions. Even if you play video games like Xbox subscriptions, they're all really small and chump change. And people routinely made the switch just thinking, I'll just go to that subscription. They'll see it so much easier. And now, fast forward 5 or 10 years, you can really see the fruits of that for the company. And people are paying, multiples of that original thing. If you flick on Copilot, for example, you're paying a lot more.
Yep.
And it goes back to that point that you made earlier on about adding value while also increasing prices means more profitability, but also more value for the consumer at the end of the day.
Yep.
Now, if I may switch gears to another business, which is Stryker, I know zero about this business.
Yep.
So can you tell us what it is, what it does, and then we'll go from there?
Yeah, absolutely. So Stryker is a US company in the healthcare space, and drilling down a bit more, it's in the medical devices space. So they're specialists in orthopedic devices, and then also robotic surgical equipment that's primarily being used then to implant those devices. So it's best in class with respect to the technology that it has. You've got over 150 million patients each year that benefit from its technology, and I think it's in over 70 countries at the moment. So it's an at-scale player, best in class, that is going to be benefiting from the aging population tailwind as time goes on.
So what would you say then, so you obviously got that technology. If we lift a little bit on that, obviously that might be one of its competitive advantages. How do you think about it, in terms of sustaining that competitive advantage? How does it do that?
Yeah, so that's what's really important here is that forward-looking piece. And so our analyst that leads the coverage on this, he is actively reviewing peers and understanding their technology lead that they have, because it is a competitive market. There are multiple players within this space, but what's really important is understanding where they are versus peers and understanding what peers need to do to be better than Stryker. So what's really key on the quality element for a business like Stryker is that first mover advantage that it has and that continued innovation. And why that first mover advantage is really important is when a surgeon learns a particular robot and has trust in the implant that Stryker has, it will then continually use that. And Stryker's technology has improved so much that the precision that surgeons have is really quite impeccable now. And then also the patient outcomes have improved significantly. So as a surgeon, for you to switch to something else, it needs to be better than that, because you are taking risk when you're moving to a new technology. So the willingness to switch is really, really low. So that is a really important place that they're in there, that the switching costs are actually quite high once they're already in. And so in the US, for example, 60% of knees replacements done through Stryker and 30% of hips. It was a newer technology that they've done. So they continue to gain share there. So it's pretty incredible. And that's just that stickiness coming through from your surgeons, really. They've got confidence in this product. Why do you take risk on something else? And it's not just it's risk for the patient. You don't need to take that risk on when you've got such confidence in the product that they have. But they continue to innovate to improve the outcomes for patients and reduce the risk for surgeons.
It's so important. It's health, right? It's the most important.
Absolutely.
Even we were on an investing podcast. People can lose money and recover, but they can't lose their life and recover, right? So these types of things are so important. And I think if we look for a homegrown example, something like Cochlear, I'm always amazed. People know Cochlear. They don't even say the hearing implant, whatever it is. They always just say it's, the Cochlear thing.
Yeah.
And it's just become synonymous with, helping people hear.
Mm-hmm.
And the reason that it's become the way it is because there's trust in that brand.
Yeah.
Surgeons and audiologists, they're not going to risk their career or their patient on something that is new and novel. Even if it is superior, it needs so much momentum behind it in order to make that switch.
Yeah.
It's just not worth it. So that's a really interesting business. And that's held in the portfolio?
Yes.
Yeah.
Yep.
Okay. Now, the final two we can bundle together because it's two peas in a pod.
Yep.
Or two payment rails that power the world, which is Visa and Mastercard.
Yep.
People are familiar with both of these. If they look down in their wallet, they'll probably see one of these.
Yep.
On the rare occasion, they might not, but most of the time they will see these two or one of them at least.
Yep.
Let's talk about these giant payment companies.
Yep.
What you see as their competitive advantage, And maybe what might be really interesting is just quickly just how they actually make money, because some people might not actually know.
Yeah. Okay. So Visa, Mastercard, as you mentioned, they're the kind of only two true global payment networks, and they're enabling commerce, be it in-store, via your wallets, and then online. And it's truly incredible what these businesses have created over the last decades. It's that ubiquitous payment. Like, to your point exactly, like you have one card, and that's pretty incredible that you can use it anywhere in the world. Like, they're in 200 countries. There's over 4 billion cards out there. Each of them have around that number.
Wow.
And over 100 million merchants, you can shop with. And what's very cool there, it's that you can use it anywhere, but it's also safe. So there's a lot of brand trust in these businesses. But in terms of how they make money, so there's a thing called interchange, and part of that is a network fee. So every time you tap your card, most of us are tapping now, they earn a basis point fee on every transaction. That's their core consumer business, what's really been the driver of their profitability over the last decades. And increasingly, they've been broadening their opportunity set. So that's through non-consumer flows. So they're often powering peer-to-peer payment networks. They're powering remittances. They're powering a lot of fintech companies now as well. And then the last piece is value-added services. And this is where they're selling software and technology to their customers, which are your banks and merchants. So what's really interesting, like the loyalty programs that you have, and that pop up that'll come up, do you get 10% off when you shop here, or managing your subscriptions? A lot of that is often Visa and Mastercard selling that service to your bank to really make your consumer experience better. So it's the revenues are really sustainable, really sticky.
Mm. It's kind of like, I remember the analogies of like the railroads.
Yes.
The railroads connected the world, and these two connect the world when it comes to money. And a lot of these other brands that come along, these, the things in your Apple Wallet, the little widgets and loyalty stuff, none of them can basically exist without these networks. And when you think about that for a moment, would you rather own the carriage or would you rather own the railway? And these two have always struck me. And to your point earlier on, I was reminded of this when you were saying at the top of the show about regulation and how important that is. These two are so powerful, but they kind of just glide under the surface of enough regulation. I remember there was it 2 years ago from now, there was a big tiff between Amazon and Visa, and Amazon tried to encourage all shoppers to not use Visa. And I think it's fair to say that Visa won that battle.
Yeah, I'd agree.
How do you think about the regulation of these things?
Yeah, so it's something that always is in the background for these businesses, and it's the risk that we monitor constantly for Visa and Mastercard, because they are an essential service. Like, they're an unregulated essential service, but they are powering commerce globally. Mm-hmm. And so when we're thinking about regulation, there's several kind of angles that we look at. One is coming from the regulator on, will they drive a new network that could compete? And increasingly we are seeing central banks drive what we call a real-time payment network that is a competing network at a domestic level to Visa and Mastercard. So we've had success in your developing markets, in India with UPI, and in Brazil with a network called PIX. They both came from the central banks, but they started more as a peer-to-peer network, and they're trying to go into commerce now, and there's a few little hiccups. But so they're trying to encourage competition through building that new technology, but it's really hard to compete with your Visa and Mastercard. So something we didn't touch on before was the network effect.
Yeah.
This is truly incredible what Visa and Mastercard have. And they really kind of they defined this economic force, which is a network effect. And that is when any participant joins the network gets stronger. This is a really high barrier to entry, especially given you've had these first movers of Visa and Mastercard and their ability to connect the world.
And
so why would you use that domestic rail to pay for your pizza when you've got trust in your Visa or Mastercard. You know it's going to work, and it works everywhere. You don't want to have to start having these additional networks to use. So adoption has been one of the trouble, one of the things that's been hard on the regulation front. And then the other thing that we monitor is just whether or not they might try and regulate that interchange fee around the world. Now, you've seen pockets where that's happened, and it kind of hits revenues for a little bit, but most of the interchange fee actually goes to the banks to fund rewards. So Visa and Mastercard, their network fee, which is just a small component of the interchange fee, is often kind of unscathed. But there's a bit of argy-bargy. I can talk for hours on how that plays out.
No, you're right. Because when I've looked at like the pie chart that shows where the money actually goes, when everyone listening and watching this will appreciate you tap your card for say like a $20 purchase and it might be like $20.40 or something. But when that 40 cents is actually broken apart, you realize that a lot of it goes to the issuing bank of your card.
Yeah.
Whoever like your card comes from, they capture so much of that, where the rails or the interchange is really not that big of the pie. And we have seen that regulation here in Australia with like the RBA trying to make sure it doesn't get out of control. We've also seen the introduction of FPOS. Many people know FPOS, but they probably don't use it nearly as much as they realize or what have you. But these companies are still thriving. So that's really fascinating. And I really like these 4 companies as demonstrations for how moats, if we think about moats just generally speaking, can apply across basically any industry.
Yeah, definitely.
And they're becoming different shapes and sizes, of course, but the way you invest can be applied across. And so I know you do this for a living, right? You take these companies, these high quality moaty companies, we'll say, and you package them in portfolios.
Yes. Yep.
With the core series in particular, that's quite interesting, I find. So I'll put literature. There'll be literature in the show notes for people who want to follow up and see exactly how you do it. But if you can give us kind of a primer on that, like how do you combine these all into portfolios?
Yeah. So what this process is really what we call our quality scores. It's the definitions that really power our research process. And the key thing in what that's doing is it's enabling us to have what we call our approved list or our investable universe. So like when you think to MSCI World and all the companies that are listed that we could invest in, you've got around 2,000.
Right.
We do our due diligence and that fundamental research that we spoke about, that gets us to around 200. Now, that's a really important step because we're picking what we view to be the winners into the future, the ones that we have greater certainty about their future earnings. And that's a really nice place to be when you've got greater certainty in those outcomes. And so for the core funds, which are our rules-based funds, we take the top typically 80 companies by quality. So we rank the quality within the universe, and we allow for diversification in that. So that's how we're using the quality scores, because our testing shows that the higher the quality score or the higher the moat of this business, that's that greater certainty in future outcomes. It leads to stronger outcomes for investors over time. And our active strategies are also using that, but they're weighing up valuation with that quality score to determine where they should be investing in at any one point in time.
Interesting. So the Magellan Core Series is those 80 stocks, and it's quality is the focus.
Correct.
Yeah, right. Yeah. Okay. So you end up with 80 companies, maybe not all as powerful as Visa or Mastercard because they're so powerful, but a whole bucket of these companies all mixed together. I might ask one follow-up question there, is just like, how are they weighted? Is it just 80 equal weight, or how does that come together?
Yeah, no, it's a really good question. So the weighting is based part on quality and then part on market cap, because there is a lot of value in that liquidity element of the businesses. So we're using those two levers as the primary starting weight, and then we do use rules to then make sure that we have that mix across companies that are more defensive, more cyclical, and have that structural growth element.
Yeah, that makes sense. Okay, so I'll put links in the show notes to that so people can go on, and there's heaps of literature, as I said, about everything, as well as videos and all different types of information that people can download. But one of my questions that I always ask is, what would you go back and change, or what would you go back and tell yourself But I thought for you, since you're a repeat customer of the show, I thought I'd ask something different, which is more recent, which is like, what's one thing you've learned about investing over the past year?
Yeah, I'm glad you're asking. Thank you for asking, because it's such an important thing in investing, is to reflect on what you've learnt. And investing, you're just always learning. Which is just such a cool thing. And that's what I love your podcast, is that people are getting that opportunity to continually learn, because markets are always changing. You have different management teams. So there's always so much going on. But then when I kind of thought back the last 12 months, maybe extend to 18 months, it was really just those disruptive technologies. It was what we've seen with respect to generative AI and also the GLP-1 obesity drugs. They've been incredibly powerful, and it's really not to underestimate that opportunity that comes through from those disruptive technologies, but then also the risks that come through, be it in the disruptors, but also the incumbents.
Okay, I like that. It's and the GLP-1s. You're the second person that highlighted them to me today, and it has become pervasive. Like talking with more people and how quickly that can change. It's such a fascinating area of science.
Yeah, no.
Well, so I do really appreciate you taking some time to come across the road yet again and join me on the podcast. Last time it was Kate, and she had the pleasure of speaking to you. This time it's me, and it's always a delight. So thank you so much for taking the time out.
No, thanks, Owen. It's great to be here.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.